So we get a lot of questions about how do I get started to buy a home and get a mortgage. So we've broken down the process into 6 bullet points we're going to discuss here today. Am I eligible? Question number 1. It's based on credit and debt to income ratio. So one of the things we're going to do in our initial conversation is we're going to pull a credit report for you with your authorization. The credit report is going to allow us to run something called the debt to income ratio. The credit report is going to give us most of the information for the numerator of the equation, which is what are your outflows. Your outflows are things like credit card debt, student loans, car loans, things like that. Along with what we're going to end up providing is going to be the mortgage, which is the other component of your new debt once you figure out what mortgage you can do. The denominator of the equation is going to be your income. So we're going to be talking about those items as am I eligible. From there, we're going to talk about your goals. The 2 major components of your goals are going to be your upfront costs and your monthly costs. So upfront costs are going to comprise of your down payment, your closing costs, and your escrows. Well, your down payment is going to be determined by whether you're going 0, 20% down, 15% down, 40% down, and that's going to determine component number 1 of your upfront costs, which is the down payment. The closing costs are going to be determined by the product, the state you're in, and some other factors. At this stage, if you haven't picked out an exact property, we're going to use some averages and estimates so that we can help you understand what number you should be provisioning for in your mind. The next piece of this is escrows. Escrows are things like prepaid items, some people call them escrow items. It's really taxes and insurance. So with your mortgage, 90% of the people who have a mortgage pay their taxes and insurance monthly within their mortgage payment. So what you have to do when you close on a mortgage up front is you have to prime that account. The priming of that account is really determined by the state that you're buying in and their tax cycle. Are they quarterly? Are they monthly? Are they annual? Are they semi-annual? And that's going to help us determine how much we should be preparing you for in your escrow account. So those 3 things come together. That's your upfront money. That's really important for people to understand what goes into that and how much they should be budgeting based on what their debt to income ratio will support and what their goals are. The next component is monthly costs. Well, the first piece of that is going to be your principal and interest payment. Your loan amount, your rate, your term. It's going to determine your principal and interest payment, and that's one of the things we're going to do first. The next piece we're going to go over is going to be the taxes. The taxes on the home, you're going to find those on the listing sheet. So every time you're out looking at a property, you're going to see a listing sheet for it. And say the annual taxes are $6,000 a year. That breaks down to $500 a month. And that's going to be recorded here as we start to figure out what are your monthly costs of the home. The next piece is PMI. The first thing to understand is PMI goes away in a conventional loan at 20% down. So if you're 20% down on your mortgage and it's conventional, there's no PMI. Less than 20% down is where we need to bring the PMI equation into our discussion. PMI is based on a factor that's determined by the amount of down payments you have that's less than 20% and based on your credit score. So, as your credit score goes up, your PMI cost, your PMI factor goes down. As your down payment goes up, your cost of your PMI factor goes down. So we'll go over that and help you understand there. Next thing is insurance. This is your homeowner's insurance. We're going to use a number in our analysis until we know exactly what you find for a property. We're going to use somewhere between $60 to $100 a month, depending on the price of the home range that you're going to be in, what state you're in. But the bottom line is you're going to go out and find the homeowner's insurance on your own. So and you're going to do that later once you're under agreement on the property. But we want to use a placeholder. Typically, our loan officers are going to use somewhere between $60 and $100, maybe call it $75 a month, and just help you understand that that's a placeholder until you line it up. Condo fees. When you purchase a home that's a condo, it's going to have a condo fee. Again, that's a listing sheet item. You'll clearly see it on there. You'll just tell us what it is, so we can factor that into our discussion and into your debt to income ratio. The next thing is flood insurance. We do a lot of work in seacoast communities, areas that have rivers that can sometimes swell. Those are the areas that flood insurance is more something that we'll talk about and make sure someone is not in a flood zone. If they are in a flood zone, it's really not a problem. They just need to understand that they're going to carry something called flood insurance. So on every loan that's written in our country every day for every borrower, there's a flood certification poll to determine if they're in a flood zone and how severe it is, because that's what really drives their monthly cost here. And we're going to make sure that we understand if that's a potential that you might run into and how to plan for that properly. Products that best fit your goals. So now that we know a bit about your credit, what you make for income, how much you feel comfortable with for upfront costs, what you feel comfortable with for monthly, we can look into the products. There's many different products. Some of the most common that we'll use are conventional, which are Fannie Mae, Freddie Mac based products. Those are going to be from 3% down to 99% down. FHA is another very common product that we'll use. Typically, most people are using that when they want a low down payment. So FHA's minimum down payment is 3.5%. So that's an applicable product for someone trying to get to a low down payment. Another product with low down payment, but is only applicable in certain states, is something called a USDA Rural Development Loan. And those can be as little as 0% down, but they have geographic and income limits. So now what you're starting to kind of understand is there's some different nuances to qualifying into these products. Another great program that we use a lot of to help people is a veterans loan, so a VA loan. So if you're an eligible veteran, VA loan is 0% down, and it's really a great product. We do them very frequently, and people love them. But for example, if you're a veteran and you're eligible for VA, but you're putting 30% down, you're probably going to find your lower cost of funds is going to be in a conventional loan. So those are the kind of things we discuss in terms of what products best fit your goals. From there, we're going to give you a list of items to upload to us through a secure link. It takes people just a few minutes. Everything they have is typically online these days. You're going to upload your 1 month's pay stubs, 2 years W-2s, 2 years federal tax returns, 2 months bank statements, and under additional documentation, certain people have in their past life divorces, a foreclosure potentially, a short sale, a bankruptcy. All those financial situations will generate a bunch of paperwork that sometimes factor into the product in terms of wait periods for if you had a foreclosure, there's a wait period before you can be eligible for a conventional loan. So if you've had one of those things in your past, really keep track of that paperwork. And if you've had one, you know that what paperwork is important and we can help you figure it out. But you'll want to grab those files and upload some of the final closeout paperwork from those situations. Or a divorce, it would be a divorce decree, because that'll show things like alimony, child support payments, which need to get factored into your debt-to-income ratio. From there, we're going to double check everything, make sure it matches with what we talked about at the beginning of our conversation. That way we make sure that you really are eligible for what we've discussed. You're going to receive a qualification letter from us with a summary of what you can do. And then you're going to get to the real fun part, which is getting out into the field and working with your realtor. You know, it's interesting. Sometimes people will we'll qualify them and 3 days later they're under agreement. Some people will qualify them and 2 years later they're under agreement. So the time frame is completely what works for you. What type of home you're looking for, what's available in the marketplace. So there's no right or wrong answer in terms of how long it's going to take. You just keep working until you find the home that's right for you. During this process, it's really important to know that we're here for you every step of the way. Call us, email us, text us. Our loan officers get back really quickly with answers to your questions. And we tend to answer a lot of things outside normal business hours because that's when you're out doing this. So definitely feel free to reach out to us whenever you have a question. Email works terrific, phone calls with detailed messages, and we can get right back to you so that you can keep moving. But that's a really fun part, and your realtor's really going to be instrumental in helping you find the home that's right for you. Eventually that's going to end up with being under agreement. You're going to find the home you like, you're going to work with the realtor, you're going to negotiate out the price that you're comfortable with, and you're going to let us know you're under agreement. At that point, people always say, what do I do next? A great thing to do is email me or fax me the purchase contract. So in certain states, there's an offer to purchase. In certain states like New Hampshire, you go directly to purchase and sales. Massachusetts, you do an offer to purchase, which then leads to a purchase and sales down the road. So, but basically, under agreement is when you have a deal put together on the home that you want. Send us that initial paperwork so we can see the sales price, the closing date, and get a feel for what you're doing. And then we're going to move into a strategy call, because now we have a known address, we have a known sales price, we have a known close date, and we can really work on the strategy of picking out which exact program, which term is going to be the best for you. And anywhere along the way, make sure you know that we're here to help you with any questions. Reach out to us anytime.